Hi, I'm Colleen Kisselburgh.
And I'm Peter Kisselburgh.
We're both crop insurance agents. This is one of a series of short videos on crop insurance. In this video, we are going to take a look at the dairy and livestock policies offered by the USDA's Risk Management Agency. This is just a quick overview to help you understand the basics of how these policies work. Most insurance policies first establish a value for the thing that is being insured, and then determine a guaranteed value based on the coverage level that you choose. The dairy and livestock insurance products are market-based policies. What does that mean? Market-based policies establish insured values and loss values based on market prices. These policies are not based on events or prices specific to your farm.
For our first example, we're going to look at dairy revenue protection. The dairy revenue protection policy insures against an unexpected drop in milk futures. Basically, a policy value is calculated for a quantity of milk that you expect to produce during an upcoming quarter-year interval. This value is based on averaged future prices from the Chicago Mercantile Exchange. So now you have a policy value based on the futures prices for an upcoming quarter. You pick a policy coverage level. That sets a guaranteed dollar value for that quarter. When that insured quarter has passed, then the Risk Management Agency will calculate a value for the insured quantity of milk using actual values from the Agricultural Marketing Service. If the calculated actual milk value is less than the guaranteed value, then the policy will pay a loss payment. Once again, these values are not based on prices from your operation. They're based on the Chicago Mercantile Exchange and the American Marketing Service prices.
Another policy is the Livestock Risk Protection Policy. It can be used to insure feeder cattle, fed cattle, or swine. A policy value is determined for your livestock based on the number of animals and the Risk Management Agency's price values. You set a guaranteed value when you choose a coverage level. Livestock values at the end of the insurance period are calculated using the Chicago Mercantile Exchange. If the calculated value at the conclusion of the insurance period is below your guaranteed value, then the policy pays an indemnity.
Another policy is the Livestock Gross Margin for Dairy policy. This looks at the gross margin for milk production. If feed prices rise and milk prices fall, then your gross margin drops. The policy will pay on drops in the calculated gross margin depending on your coverage level. Again, this is a market-based policy. Chicago Mercantile Exchange values for milk and feed costs are used to determine changes in the gross margin over an insured period of time.
Finally, one thing these policies have in common is that the amount of insurance you can have is based on the volume of what you produce. So even though your prices may not be considered, you will still have to document whatever the policy is based on. It could be the pounds of milk produced or the component values of your milk, or the number and type of livestock that you are growing. These livestock policies are very different from other crop insurance policies. Please talk to a qualified crop insurance agent to get more details as to how these policies will work for you. We would like to thank you for watching this video. Please take a look at some of the other videos in this series on crop insurance.
Thank you.
Thank you.